Well, hello everybody. This video could not happen at a more opportune time, whether good or bad. It's kind of crazy what's going on in the market, and I am so pleased to have Darius Dale, the skipper, the captain, DD. I don't know what I should call you. I know you by all these handles, but there couldn't be a better time.
Darius Dale.
Yeah. Okay. Well, I know a lot of my audience follows you as well. That's pretty incredible. So a lot of people that are watching today, do you want to have maybe some comfort as we figure out where we are in this cycle, where we are with the macro? Maybe we can draw a couple of lines in the sand. We can hopefully dive into how we identify tops, bottoms. Is the bull market over? The impact of tariffs, the impact of gold. What's your 2025 game plan, allocations? So much to talk about. You ready to go? I'm going to start by introducing you
Always,
to the people.
man.
For those people that may not know, Darius Dale, you've got some very, very interesting background. You and I actually have similar background. I came to this land with a bicycle and a suitcase in the early 90s. So we've scraped our way to where we are today. I didn't mean for that to rhyme, by the way. But you have a very interesting perspective on markets, on macro, on AI, on Bitcoin. It's like perfect because I am personally all in on crypto and AI. They're my two narratives that I follow, and I think you're very similar. So let's get into the story, if you're good with that. And
I appreciate the kind introduction, man. You are doing what I think is needed to be done out there, man. Like you are taking institutional knowledge and actually democratizing it and giving it to empower investors. And I'm proud of what you built, man. So I'm pumped to be here.
Yeah, I think that'll be a cool conversation for sure. Now, there's so many places where we could start, and I think we should probably start with the number one question that are on people's minds today. Bitcoin has fallen $10,000 in 2 days. People are freaking out. I can't tell you the number of people that think the bull market is over. It's done. Alts are done. S&P 500's done. We're heading into a big recession. And we've been hearing about recession now for years and years. Jamie Dimon was calling for the cataclysmic storm since 2022, etc. Give us your take on where we are right now. Is it the end of the world, or are we still in the bull run?
Yeah, great question. I'm going to make that question 1B and add a question 1A and then answer it myself if you don't mind.
Yeah.
So I love starting these interviews with kind of how we think about the world because I think it's so important to contextualize everything everything else we say from that starting point. A lot of folks, I obviously do a lot of media, and I feel like a lot of times, in these conversations, we spend a lot of time talking about things like liquidity, growth, inflation, monetary policy, fiscal policy, even the corporate profit cycle. And the reality is, in terms of how that fits into how we help our clients make money here at 42 Macro, it's really just in the context of helping them prepare for regime change in the context of our quantitative signals. The number one thing we do for our clients is identify and help them position for the market regime using our case portfolio construction process for retail investors. That's a 60-30-10 trend following strategy featuring stocks, gold, and Bitcoin. And then our discretionary risk management overlay takes a lot of those same underlying models and then creates, proper trade recommendations for at the factor level across 70 different factors. And
you went a bit fast there for the audience. 60-30-10, no bonds, gold and Bitcoin. What's the 10%? Is that Bitcoin?
I wouldn't touch a bond with a 30-foot pole.
Either would I. Never have, never will.
Yeah.
What's the 10%?
The Bitcoin. Yeah. 60,
okay.
Yeah. So we replaced the 40 in terms of the bond allocation with 30% gold, which mimics bonds in terms of the beta of the asset class, and then add a little kicker of Bitcoin because I ultimately think that a lot of the dynamics why you would want to be long a bond ultimately have the same characteristics of being long Bitcoin. They're just not necessarily correlated in the moment.
And gold had its best year, or the best last 12 months in the last 12 years, which is interesting.
Made a lot of money in gold in the past, 18 months or so. Yeah. It's been a while, but
from my experience, when gold is so strong, that's when the alarm bells should be going off. Are there alarm bells going off in your mind? Or is this
let's get back into question 1B. Yeah. So I just want to make sure everyone understands that, hey, like we're going to talk about a lot of things. Some of it's going to be bullish, some of it's going to be bearish, but none of that stuff has any bearing on how we how we think our clients should be, positioned. At the end of the day, how our clients should be positioned is through the lens of those systematic processes, right? If I predict well, then those systematic processes will evolve in a way that are in line with those predictions. If I predict poorly, then they're just going to evolve in the way that is most appropriate for managing risk in the moment. And so that's my job is not to tell them what to do based on growth, inflation, liquidity, et cetera. My job is to communicate the signals to them, and when the signals change, and we could be on the precipice of a signal change, as evidenced by the nature of your questions.
Yeah. And it's interesting because my approach is somewhat similar. So when I start to get nervous, which is like 5 or 6 months ago, I start stacking cash and ease up on risk assets, stop allocating certain things unless I see them as very undervalued assets. Is your approach somewhat similar for your clients? You tell them to take your foot off the gas or move to cash or move to gold?
We don't make any fundamentally oriented investment recommendations ever. So if our systems get nervous, if our market regime nowcasting process gets nervous, or if the individual volatility adjusted momentum signals that guide our equity, crypto, commodity, fixed income, allocations in Dr. Mo get nervous, or in KISS get nervous, then that's when the position sizes will come down. What we found is, just by my own experience on Wall Street and on global Wall Street for 16 years, and just back testing a lot of other strategies and observing a lot of other things in markets, is that people's ability to forecast is not as good as they pretend it is. And more importantly, it's actually gotten significantly worse. Like if you look at the forecast error on Bloomberg consensus growth and inflation estimates, for instance, it's widened dramatically on like a trailing 5-year basis over the last 5 years. So in my opinion, I think the validity of, and again, this is just my own way of skinning the cat. There's a million ways to skin the cat. Obviously ours works, but our way of skinning the cat is respecting the evolution of the market regime, participating in what the market is trying to price in, irrespective of what you think is going to happen. Now, again, I'm very good at predicting growth, inflation, liquidity, all that kind of stuff. So a lot of times what happens in the markets is consistent with what we forecast, but oftentimes, not often, but there are times where it doesn't, where I have forecast error. But what I don't want, and for everyone listening, this is probably the most important statement, I don't want our clients losing money because I got a prediction about growth, inflation, policy, inflation, the liquidity wrong, or some fundamental forecast wrong. If our clients lose money, it's going to be because the markets are moving faster than our systems can pick up, or some other reason, right? There's some that means there's an exogenous shock that was unable to be forecasted anyway. So you can't really forecast that stuff. So we are essentially changing the shape of the distribution of the outcomes that our clients feel in their portfolio. We're making it a more positively skewed distribution, because ultimately what we find is that fundamentally oriented forecast error causes bigger drawdowns in investor portfolios. Like if you're wrong about growth, inflation, policy, liquidity, et cetera, it takes you longer to realize that you're wrong, because economic statistics and policy changes happen on a much faster or much longer lag than changes in volatility characteristics in asset markets, changes in correlations across asset markets. Those risk management signals always change before the actual catalyst.
You've triggered a question in my mind. The fact that the so-called traditional experts, Wall Street analysts, you name it, macro experts, us excluded, of course, have been getting it wronger and wronger over the last 5 years. Is the world getting stupider, or are the markets manipulated?
They're getting it less right. So
that's wrong. But is that part of a master plan? Because we know manipulation has always existed since the beginning of time. Like for example, when Jamie Dimon was so bearish on the markets, I know you said Diamond, and I know JP Morgan had a whole bunch of S&P 500 puts. Was he trying to talk the market down for his own bags?
Maybe not. I have no idea. The reality is that has no bearing on whether our clients can make money or not. So it's an irrelevant statement to me. It's about as useful as, what color is this car I'm looking at outside, or, what the temperature is, it's noise. Now, are there perverse incentives on Wall Street that tend to favor the people causing the transactions and allocating the assets? Yeah, of course. That's how Wall Street gets paid. But at the end of the day, as long as you are smart enough to recognize the incentives of that system, and more importantly, partner with firms that don't have those same types of incentives, that actually just want to help you make money, then I think you can do really well as a retail investor. And in fact, I think there's was some articles coming out recently like, hey, retail is actually outperforming institutional. And that makes a lot of sense to me in the context of folks like you, folks like myself, who have this institutional background are actually democratizing what I believe is, some of the best practices on global Wall Street in terms of helping clients stay on the right side of market risk.
Yeah, and we've seen that happen in so many areas too. Also in media, like you see, small YouTube channels now get more views than CNN and CNBS,
They do
CNBC and
need
stuff.
more views. This has been going on for years. Yeah.
Yeah, but it's an accelerator. So it's as if everything is changing. The world is turning on its head, and we'll talk a lot about turning real soon. So let's get back to the first question. We got 1A. Let's get to 1B.
Yep.
Bull market. Where do we stand?
Yeah, look, I mean, our systems are currently still in a risk on market regime. Like if you just look at it, I mean, it's a very simplistic way to think about it, but using the S&P 500 as a kind of the lowest common denominator, we've had a lot of violent, high realized volatility chop on a day-to-day, week-to-week basis, largely driven by speculation around policy, general policy uncertainty coming out of the Trump administration. And that's not a political statement; it's just is true. These are, realized the volatility facts. But the reality is like we're basically in the same place that we were in mid-January, the same place we were in mid-December, we're in the same place that we were in mid-November. So like not much has actually happened, but
Yeah.
it feels like a lot has happened because investors are nervous about the pace and ultimately the distribution, the speed with which the distribution of probable policy and ultimately economic outcomes is changing, right? And so that nervousness makes it feel like when we have these down days like we were currently mired in since Friday, it'll feel like it's worse than it actually is. But when you zoom out, you just realize we've just been chopping back and forth for a while, and that may continue for a while.
Yeah, it's actually when you zoom out. I spend a lot of time zooming out as well. I was just looking at a deck I created on the 4th of July. I call it Financial Independence Day. Of course, Independence Day in the US, but it's just play on words. But I remember, I think Tesla was at $170. Bitcoin was at $60,000. And literally, that's just only 6 months ago.
Yeah.
Like what goes up fast comes down fast. Everything mean reverts and risk happens fast. So do you agree with those same principles as well?
Yeah, typically, yeah, that's certainly the experience of most asset markets. It doesn't
Yeah.
always have to be that way, but yeah, agreed. Just on, I'm glad that you brought up the speed with which asset markets repriced. Kind of starting to when they started pricing in the election back in September, and obviously that kind of culminated with the highs in S&P kind of in early December. We kind of recently breached that high. It's basically the same high. We got to the high in Bitcoin, I want to say in mid December. The speed with which markets kind of priced in this sort of Trump bump to the economy, the Trump bump to business and investor confidence that has dissipated because we talked about in our morning note this morning and in several morning notes. And in fact, if you look at our triple S's theme, I put our fundamental research themes on the board here. If you think about our fundamental research themes, the most recent thing we authored was back in November of last year, and the theme was sort of essentially calling out the risk to asset markets, which had a precondition of crowded bullish positioning regarding the size, sequence, and scope of these, potentially dramatic changes to fiscal, regulatory, and trade policy, right? Like you could have all the bad stuff come first, tariffs, securing the border in terms of the impact that will have on the labor market, come before the good stuff. We've had some positive developments on that front in recent weeks, particularly from the perspective of the debt limit and Treasuries, the quarterly refunding, kind of outlook. Those things have kind of come in better than expected. But I would say what's been worse than expected is just and again, this is not a political statement. I'm a data-driven centrist, always will be until someone puts me in 6 feet under in a casket. I would argue the frantic and chaotic pace with which President Trump is issuing executive orders, creating headlines and ultimately changing his mind back and forth regarding some very serious policy outcomes. In my opinion, I think the markets are starting to throw in the towel a little bit. Now, again, will it break us out of this choppy trading range? We'll see. I think you need to have real durable change in the economic outlook and real durable change in the policy outlook as it relates to the Fed or something else to really sustain a trending risk off market regime. But it certainly feels that way, over the past few days.
Yeah, and that's takes me to when this all first started. I think the current president is smart enough to know that tariffs don't really help anybody unless, of course, you got a very severe imbalance of trade. First of all, second of all, I think he also, based on his book from years ago, The Art of the Deal, he used it as a negotiation tactic. So a lot of it is more noise than maybe actual intent. And third, if he implemented, say, just Canada and Mexico alone, 25%, he would put a pin in the US auto industry overnight.
Yeah.
Literally destroy Ford, GM, Chrysler, whatever, Stellantis, whatever they call it now, and many other industries. They would be destroyed because they get a lot of their raw materials from Canada and Mexico. A lot of the parts for vehicles are sourced out of Mexico. So do you think it's bluster to negotiate, to stop fentanyl, to onshore more business, or combination of factors? Or do you think he'll actually go through with it, or go through with it in a way where he excises out things that would destroy the car businesses, etc.? Loaded question.
Well, I think that's a phenomenal question because ultimately you have to put yourself in his shoes from a game theory perspective. What does he actually want, right?
Yeah.
Like, what does he want? He wants what he campaigned on, which is to save the American middle class from globalization, right? That's what he actually wants. Now, tariffs are in fact a negotiation tool to the end of saving the American middle class from globalization. Now, how does he actually save the American middle class from globalization? It probably is not going to end up with 25% tariffs on the whole entirely large industries in terms of that are responsible for creating millions of jobs in this country. That's probably not going to be the end result. So if you follow the bouncing ball backwards, what I think he wants to do is kind of reorganize the kind of global trading relationships. And really, this goes back to a broader topic that you and I will discuss later, or maybe even now, but the fourth turning. Like the whole entire world is set up for the US to be the reserve currency and for us to run structural trade deficits so that we can, send dollars to the rest of the world so the rest of the world can grow. That's been the deal. President Trump seems like he either doesn't understand the deal. That's been the case since Bretton Woods, or since Nixon abandoned the gold standard in 71, or he doesn't care about the deal anymore and just wants a new deal. And whatever that new deal, I don't know if we know what the new deal looks like. I think they're spitballing, quite frankly, and it's annoying to markets, as we can see in terms of the tape. But at the end of the day, we know a deal is probably the highest probability outcome, as opposed to let's just throw up a bunch of tariff barriers and hope for the best, right? That to me seems like it's a less straightforward path to getting what he wants, which is to save the American middle class from globalization.
Okay, very well said. I like the way you view the world. And before we get into crypto, Bitcoin, AI, allocations, top spotting, we have to talk about the elephant in the room, and that is what I refer to, and many others, the global debt spiral and the stuff that's happening in the US today. Doge, we have 9 trillion, maybe more, that's going into a much higher coupon. The deficits are 2 trillion. To what extent are we in that debt spiral? Can we escape it? And can Doge help? And what impact does it have on inflation? Again, this is a very difficult question, but I know you can answer it.
Oh, look, man, I spend a tremendous amount of time trying to ask and answer the hard questions, and this is just one of them. So you can ask me as many hard questions as you want. I assure you, I have a slide or 5 prepared for that. So let me start by saying, yes, we are on a very unsustainable fiscal path. What we show in this chart here, the blue line in the top panel, is the 5-year moving average of nominal GDP, currently at 6.4%. The red line in the top panel shows the 5-year moving average of the budget deficit to GDP ratio, which is 8.6%. And so if you take the spread of those two, panels, or two metrics, we've been generally running at a positive spread with respect to the budget trailing 5-year budget deficit relative to the trailing 5-year nominal growth rate, right? That's a significant departure from what we've experienced over the past, let's call it 40, 50 years. And the reason that's important is because we're now on a path of accelerating debt accumulation, right? Like, we obviously know, like, the government tends to grow faster over time. It's been really basically since 2001, been growing faster than than growth. But it's now, if you sort of accumulate it, we now realize that structurally the economy is growing X, structurally the budget deficits are Y, and the Y is greater than X. That's now kind of the new condition that we are experiencing. And so when you enter Doge, like this Department of Government Efficiency, the people voted for it for very much so in terms of using this as an opportunity to rein in the government and sort of kind of shrink expenditures in a way that would potentially bring down inflation. I think there are folks like myself and you know, we're kind of well versed in the fork turning, who understand how important this is from a secular standpoint in terms of limiting the risk of potential loss of U.S. exorbitant privilege, or a potential war that could, result in the loss of a U.S. exorbitant privilege. Let's say China tries to dump our treasuries or something like that. I don't know. I don't want to go down that too far that rabbit hole yet. But Doge, when you look at the efforts for Doge, I remain incredibly disappointed at the scope of the project, because ultimately it's not going to achieve the kind of significant deficit reduction that we're talking about. In our opinion, Doge is going to achieve, when it's all said and done. Right now, they're still kind of bean counting small things, but I think when it's all said and done, they're probably going to achieve significant expenditure reduction. Now, notice I said expenditure, not deficit. When you layer on the other factors, that Doge have been ring fenced from a political standpoint, plus the addition and the extension and expansion of the Trump tax cuts, you're probably going to wind up in a situation where budget deficits are about the same, or maybe even potentially worse, right? Especially if they can't get the fund of the underlying trend of growth higher. So let me throw a few statistics at you to kind of support what I just said. If you look at sort of Doge's remit, right, they've already sort of ring fenced Medicare, national defense, Social Security from that process. Net interest, obviously, they can't control. We know that's going to go up by another $100+ billion in 2025, just as a function of rolling over debt into a higher interest rate regime, rolling over lower yielding debt into a higher interest rate regime. They don't want, President Trump has already said, don't touch Social Security, don't touch Medicare. And then recently he's come out and said, don't touch Medicaid as well. And so if you think about all those 5 categories, which Doge is really not going to be able to take the chainsaw, Elon's famous chainsaw to, that those 5 categories are, if you look at it on an annualized calendar year to date basis, it's somewhere around $5.6 trillion. It's 73% of total federal budget government expenditures. It's about 16% of nominal GDP. And oh, by the way, it's been growing at a trailing 3-year CAGR of plus 13%. Right. So let me say that again. The 73% of the federal budget that Doge is not allowed to make significant changes to is growing at a trailing 3-year CAGR of plus 13%. Right. And I can already said why net interest is going to continue to rise over at least the next 2 years. We know Social Security, Medicare are going to continue to rise because, as we see in this chart here, the United States old age dependency ratio is going to go from about 25% to 35% over the next 10 years. So whatever we're spending on Medicare and Social Security now, and more importantly, the tax base that we have associated with that, those 2 things are going to move in the wrong direction. Exactly. And then, you and I briefly talked about this in the preamble, or not the preamble, in the pre-production, but AI is another factor. When you think about Medicaid, you think about, the potential loss of white collar jobs across America, maybe not tomorrow or even next year, but over time, we're probably going to have a slower growth rate in total employment, and maybe even turn negative at some point. It's my expectation that it will turn negative at some point. And so if you layer that on, you probably got Medicaid continuing to rise. And so again, 3/4 of the federal budget has essentially been ring fenced from Doge for political reasons, or economic reasons in terms of net interest. And that stuff's compounding at double-digit growth rates. So Doge has to chop off the rest of the 25% that it can play around with. Like, it basically has to take that to zero just to kind of offset the growth of these things. And so in our opinion, Doge is going to be unsuccessful at achieving significant deficit reduction, even though any little bit that they do helps move us in the right direction. So I'm a big fan of the program. It's just not going to do what a lot of folks on Twitter who don't do this kind of analysis hope it's going to do.
Well, mathematically, we both know that once debt to GDP goes beyond 77%, you're beyond the point of no return. You can never get back unless something brilliant happens, like AI compounds GDP, but that's separate. But getting back to the stuff that you said was ring fenced. So the 2 big ones, say defense is $1 trillion, Social Security, etc., another $1 trillion. Elon Musk already found 70 billion of fraud within Social Security. So that helps. I calculate that helps Social Security last out, say, from 2032 to 2035, maybe longer, if they continue to find that. And maybe Hegseth and others in the Pentagon will find a lot of waste, which could reduce the defense budget. And I believe, anyway, war has changed. It's not about, I see an aircraft carrier as a sitting duck against 10 million drones. It's just, the world is different. It's very different. And people still don't realize it yet. But Anyway, we got to move on because we got a lot of stuff to
No,
talk
no,
about.
I don't. Let's not. This is a very. I think this is the topic du jour of our time right now. It's Doge,
Yeah.
because at the end of the day, I think you're spot on, right? Like, he's going to come in and find waste, fraud, and abuse in every agency, right? But like, what percentage of total expenditures in a program like Social Security, which is literally sending out checks to people, or Medicare, which is convoluted system of delivering healthcare to senior citizens, how much waste, fraud, and abuse can there be? Right? Like, is it 10% of those programs, 20% of those programs, 30% of those programs? It's our estimation that it's probably not as high as we are, just based on the lack of progress that they've made thus far, right? Like, if they've been on this program, they've been trying to do this for 6 months now, right? Like, even prior to the actually President Trump becoming in office. So they might not have had access to all the data, but they certainly have access to the same data that we have in terms of being able to scour the federal expenditures. And so it's our view that, hey, they're going to come in and do some great things. Now, again, they don't have a remit to cut at the size and speed, expediency, and ultimately and be as draconian as they need to be, just to offset the structural growth of these categories, right? You're not cutting and have it be zero, or have it go from X to something X minus Y. Your X is going to continue to grow in the future, so Y, the amount of Doge cuts, has to continue to grow, or have to be big enough to offset that in the future. In our opinion, just based on our analysis of the budget dynamics, which I think is some of the best in the world, it's unlikely.
Good. Okay, we agree. Because I believe we're beyond the point of no return, and they can help, but they can't fix.
Yeah,
So you're
exactly.
dead right on that. We're on the same page.
Great way to summarize it. That Doge is going to help. We're moving in the right direction in this
Yeah.
regard, and with respect to Doge, but it's not going to fix the problem, especially when you're talking about layering on $4.5 trillion of additional tax cuts. It's not helping the problem.
But the level of fraud, like if you look at all the law cases now about fraud in Medicare, Medicaid, stuff I don't understand at all, but I do know people basically push medications at a very high price that's paid for by the government onto every single patient, whether it's a cream or a pill or a therapy, or it's out of control. So I think AI and the team can help with that. Let's talk about it. So let's talk about the world for a second. Global liquidity, Europe, ECB. I mean, all the data, at least in 2024, that I saw come out of Europe, I found to be incredibly alarming. It's no secret. I come from there, and what I see happening is shocking. And then I see the complete domination of things like manufacturing out of China, eating, the powerhouse of Europe, which is Germany, absolutely obliterating them. We haven't even seen the pain hit yet. And what's your view on Europe, China, the rest of the world, liquidity? Are some of these places going to the moon and others going to the toilet, or is everything going to be fine?
Yeah, great question. So, we run our grid model for every major economy in the world, certainly investable on the institutional side. And with respect to Europe, we have European growth kind of meandering higher over the medium term. I would say what's more of a bigger factor is the fact that we have European inflation meandering higher over the medium term. And so ultimately, obviously, there's a lot of rate cuts that I want to say over the next 12 months. There's about 3 rate cuts priced in the euro money markets right now. Will that get priced out? If that gets priced out, do we see a stronger euro and a weaker dollar? A stronger euro and a weaker dollar, all else being equal, you're probably going to wind up with a kind of meandering uptrend in global liquidity, right? The dollar is very inversely correlated to global liquidity, as are global interest rates, as are global bond vol, as is global currency volatility. There's other indicators as well, but those are kind of the main ones on the market side of things that tend to be kind of shorter term leading indicators. The economic ones are kind of medium term leading indicators. We know global liquidity is a key driver of asset markets. What we're showing. So, by the way, I didn't explain this, but the black line in these charts, each of these charts you're going to see here, is just our global liquidity proxy. So we track global liquidity very closely here at 42 Macro, and forecasted very well. If you look at so how we derive our metric is it's the aggregated sum of the 10 largest central bank balance sheets, the borrowed money supply from those economies, and their fiat FX reserves. All those are kind of the 3 main baskets of which private sector savings are generated in order to capitalize asset markets. And so when you put those things together, we can see that, okay, we're currently moving in the wrong direction. We're kind of starting to bottom. Our model has it kind of meandering higher over the medium term. That's kind of somewhat of a big deal if you look at the gap between how liquidities perform and global equities have performed. I would argue there's a lot of AI priced into that. Bitcoin is still that tight. That correlation is still super tight there. The correlations are still super tight. It's just the spread You have to be somewhat concerned about a lot of the concentration we've seen in the AI theme. One thing I'll say on that concentration is when you look at our positioning model, and this goes back to what we talked about earlier, the indicators that kind of correspond to the medium to longer term outlook for asset markets, kind of like the AI stock allocation survey, the bond allocation survey, the cash allocation survey, realized vol as a proxy for systematic fund exposure, implied vol correlations as a proxy for market neutral fund exposure, market multiples, investment grade credit spreads. Most of those indicators are at or breaching, or either near or breaching levels that are consistent with major bull market peaks, right? So like, we need the liquidity to accelerate. Like the liquidity better accelerate, right? And we have a high probability view that liquidity is going to accelerate here in the U.S. as a function of the debt selling primarily. But the global liquidity picture is a little bit more convoluted, just in the context of the tariff discussion. Is Europe actually finally starting to get out of the mud economically? I think the jury's still out on that, even though we do have it accelerating over the medium term.
In fact, I'll scare people even more. If the global liquidity does not increase, we face a global financial crisis. Agree?
Okay, unpack that. That's a hot take.
Yeah. So the planet Earth, commerce, etc., is built on a world of debt that's inescapable. But if they try and tame inflation, which is incredibly sticky, the only thing like the Fed, etc., ECB can do is destroy demand. They can't control inflation. I've always said this. I've always seen this. Monetary phenomenon, you name it, all the history stuff that we've both seen. But if they try to play hardball in compressing liquidity for an extended period of time, that could bring about a gap, which could bring about a global financial crisis very easily. Once liquidity dries up, the economy stops, boom, and then there's a death spiral. That's my take, which I think they should be aware of. Or am I too alarmist here?
No, well, look, I don't want to paint you with a broad stroke. Sure, there's a lot of nuance to your view. I will say that there are other levers in the system, but to your point, I do think there are the thing that you flagged with respect to how hard are they willing to push on the inflation, metric, or how willing are they to get inflation back to 2%, at least here in the United States, will be a key determinant of asset market performance in 2025. And here's why, in my opinion, it's so important. When you look at our grid model for the U.S., so for every major economy in the world, we forecast growth, we forecast inflation, and the top panel is all the institutional math that you probably don't need as a retail investor for the institutional side. So in terms of our forecast for core PC inflation, we have it bottoming in Q1 and starting to meander higher throughout the year. Wall Street economist consensus has it bottoming in Q1, meandering higher throughout the rest of Q1, and then starting to decelerate for the rest of the year. And by the way, that's actually a more hawkish forecast than they had, a month ago, when they were just straight down all year, just like the Fed. So they're kind of just much like they did with our growth forecast over the past couple of years. Recall that we authored the resilient U.S. economy theme back in the summer of 2022. Much like they did then, they're now kind of catching up to where we were in inflation, right? We stay 1 to 2 years ahead of Wall Street consensus on these major big inflections in growth and inflation cycles and liquidity cycles and profit cycles. But we don't need to toot our own horn for too much. But getting back into this this uptrend in inflation, if this uptrend in inflation materializes, i.e., if our forecasts are actually closer to accurate than the red line, which is Bloomberg consensus, Wall Street economist consensus, the Fed is going to have a real tough choice to make this year. Do we kind of say, okay, we see inflation reaccelerating. We're concerned about inflation expectations. How, let's at the bare minimum, force markets to price out all of the rate cuts that are currently priced in. There's about 2.5 rate cuts priced into US dollar money markets over the next 12 months. Their neutral rate is currently at 3%. So the Fed currently thinks it's about 150 basis points in restrictive territory. Do they revise that much higher to a level that's much more commensurate with the current policy rate, which will ultimately cause the bond market to have a significant hawkish repricing because they're expecting a lot of cuts over the long term? If that is something the Fed does, we will see a too strong U.S. dollar on, that's aided and abetted by, tariffs, et cetera, that causes a significant reduction in global liquidity. And to your point, potential financial Armageddon, or I forget the phrase you used. What was the phrase you used?
Like a global financial crisis 2.0.
Crisis 2.0. So that is certainly, in our opinion, that is definitely a risk.
Yeah.
Another risk is a Fed that plays ball, right? A Fed that says, you know what? I don't want to make this complicated situation any more complicated. let me just do what I have to do to acknowledge the fact that the economy has changed. The equilibrium inflation rate is probably higher. Therefore, I must have a de facto or de jure positive revision, upward revision to our inflation target. I think they already have, by the way. They've been cutting interest rates with super core PC inflation at 3 to 4%. Right? They already revised their inflation target higher just based on their behavior. We're saying they need to take that a step further at some point this year. And the reason why is if you look at our model, our secular inflation model, which we built in January 2022, we've been refreshing it every month for our clients since January of 2022 in our monthly macro scouting reports. And it said on the high end, the equilibrium core PC inflation rate, which would be the horizontal line in this kind of stylized diagram, that equilibrium rate is kind of in the high end, 3.2, 3.3, and on the low end, somewhere around 2.6, 2.7. Right now, it's currently saying it's somewhere between 2.9 and 3.0. But again, I don't want to be too specific about that. But the reality is 3, high twos, low threes, it's very much not 2. And so it ultimately means the Fed that wants to needs to definitely send the economy into a recession just to even have a hope and heck to get to 2% inflation. And so this goes back to, I think, our earlier point that I was trying to make, which is, I think the Fed is going to try to play ball here, right? Like you don't want to be the you don't want to pile on, right? Like we could have potentially some significantly negative changes from the side of a fiscal and regulatory policy. We already got them, right? We already got more tariffs. We're going to get more tariffs, probably not as much as the markets are fearing today, but more tariffs are coming. They're going to need some revenue offsets in the reconciliation process to extend and expand the Trump tax cuts. So more tariffs are on the way. We know that they secure at the border. That's going to be inflationary from the perspective of reducing supply of labor and ultimately causing wage inflation to stabilize at a much higher level than previous cycles. And by the way, it's already contributing a meaningful amount of inflationary pressure in the context of this model. So I don't think the Fed is going to want to be causing incremental financial stability concerns in the context of all that, but they may. And if they do, we will have a significant crash in 2025. I think you can set your Rolex to that.
Or they can continue to cook the books. They remove coffee already. They can remove eggs and car insurance, and then everything is fine. But let's talk about. We'll move on from inflation.
Choice, right? That's not the Fed's choice. That's the BLS. And I'm guessing, the Trump administration, who was elected to bring down inflation for low to medium income consumers, they're going to pull every lever they can, including cooking the books on the inflation statistics to get the inflation rates down, because they ultimately know some of the policies they've enacted. The policies they've enacted thus far are inflationary. Tariffs are inflationary. Sorry, I don't want to say inflationary. Tariffs are one-off price level change, but they will feel like inflation to consumers in 2025. They're not inflationary. They just will feel like inflation. So consumers will get incrementally upset. And then the securing of the border and the hawkish impact that's likely to have on wage inflation, that is structurally inflationary. So in my opinion, they're going to have to do what they can to get inflation statistics down. But to me, again, this is about what will the Fed do to use its balance sheet to take some pressure off of us investors in terms of capitalizing the treasury market. That to me is the big question of our time, and we'll find out the answer to that before December 31st.
And a quick summary, liquidity has to rise in 2025, which means it'll float all boats. But let's talk about a couple of charts. I've built this back in 2021, 2022. A macro model is about 20 different elements, unemployment, growth, etc. We know, for example, GDP growth in the United States. I calculated if the government didn't spend to inflate GDP growth, it would have been minus 7%, not plus 2% or whatever. It's kind of crazy how much they spent. The question is, will that continue? And we know that the current president in office, his benchmark, his scorecard is always the stock market. So he wants the stock market to go up. But this is 3 little charts I want to run by you. This is the macro model, and it shows you the correlation with Bitcoin. Loose correlation, except mid 2024, it fell because of the hype of the ETFs, etc. But normally Bitcoin follows this model. The orange is the big downtrend bear. Then macro versus AI, NVIDIA, big breakdown compared to the performance of AI. And you hinted at this earlier. This is why I'm sharing this right now, because it's interesting. AI is far outperforming compared to where the typical economy would be. And if you compare macro to the S&P 500, it's down, which means technically S&P 500 is very much overbought compared to where the macro is. But maybe a large part of the S&P 500 is driven by AI. So just some things that are going to take us to our next conversation right now. But any thoughts on some of that stuff? and looking at those buckets?
Yeah. Yeah. Well, I'll start by saying excellent job sort of, creating a model, explanatory model. I think that's a very useful tool to think about how to manage, I think it's in my opinion, and maybe you disagree, but in my opinion, I think that's a helpful valuation oriented tool. Are we overpriced or underpriced
Yeah.
relative to the macro conditions, relative to the observed macro conditions?
Exactly.
That's
So for
yeah.
the interpretation, because you talk a lot about identifying tops and when to go risk off, risk on, that tells me, okay, you're still okay in Bitcoin, you're still okay in Nvidia, but you should probably think about if you're in the S&P 500 SPX ETF or something, take some off. That's basically
We
the
wouldn't think
message.
about it that way. So if we had a negative, that's the implication of what your models is
Yeah.
suggesting. I don't have a basis to agree or disagree. In terms of how we think about it, is our market regime nowcasting system, which scans 42 market. Actually, it's a lot easier just to show on a chart. I always get myself in trouble when I start just talking about very complicated things without showing the chart. So in terms of, you look at our market regime nowcasting system, what that system does is it scores 42 of the most important institutional markets in the world. These are the markets where the smartest, most capitalized firms across global Wall Street are participating in the most. We score them through the lens of our volatility adjustable minimum signal, and then we summarize that information here. So at any point in time, whichever regime has the highest sum and share of confirming markets, of the confirming VAM signals in this model, we'll say, okay, that's the regime that Wall Street is trying to price in. This is the theme that Wall Street is trying to price in. So you can be Goldilocks, which is risk on with an disinflationary bias. You can be reflation, which is risk on with an inflationary bias. You can be inflation, which is risk off with the inflationary bias, or you can be deflation, which is risk off with the deflationary bias. And so what we know is, okay, we're currently in a reflation regime. How long will this reflation regime persist? I think the ability for forecasters like myself to answer that question is about as low as it's been. Again, going back to my entire 16-year career, the wider the width of the distribution of probable economic and policy outcomes, the more forecast error you should expect as an investor, right? Like, these are the kind of conversations that we have with institutional investors that probably don't resonate with retail investors as much, but these are the people who are managing trillions of dollars of other people's money. These are the conversations that we're having. And so in the context of that, we need to be aware that, hey, reflation, even though I think the liquidity situation is fine on the global side, I think we're fine for at least another 1 to 2 quarters. On the U.S. liquidity side, we're more than high probability we're going to be fine for another 1 to 2 quarters. I don't see a scenario where we sort of sustain a risk-off market regime, even if we sort of transition to one. I don't even think we're probably going to transition one. I think we're still going to have this violent chop for a while with a natural kind of uplift to markets because of reflation or because of liquidity. But if that's wrong, then this system will now cast us into a risk-off market regime. And that's kind of the key takeaway, is that once it now casts us into a risk-off market regime, then our one of our core risk management systems like Dr. Mo, that'll say, hey, get us into a risk-off regime on that day, and change the proper trade recommendations across all the major asset classes, stocks, equity factors, equity sectors, global equities, fixed income sectors, credit sectors, currencies, commodities, and crypto. It'll change all the proper trade recommendations associated with that once the risk-off market regime presents itself. We don't live in the world where we're trying to predict when that happens. I don't think anybody with the distribution of probable economic and financial market outcomes is smart enough to predict when that is going to occur. What we do here at 42 Macro, and I'll shut up and let you ask your question, James. What we do here at 42 Macro is we observe and respond. Most people are, kind of predicting and have this kind of beautiful narrative constructed in their head. And then when their positions are down enough, they say, okay, my narrative is wrong. What we do is say, okay, our positions are down a little bit. The market, the winds are changing. Let's adjust the sails. And I think it has really worked well for our clients.
Okay, let's get back to Bitcoin real quick for a couple of minutes, and then we'll go to fourth turning and AI, because I got an interesting theory on that one, which I've never shared before until today. So let's talk about the Bitcoin bull market is not over, as we discussed earlier. It's not over either for the stock market. It's just chop, aggressive. There's a lot of uncertainty. Once we get through this tariff stuff, everything will start to go back up. Liquidity will go back up, etc. They're not going to put a pin in the whole economy. I don't see that happening. Now, you got these state Bitcoin reserves happening all over the place. You have rumors about a Fort Knox audit happening. Acquisition of MicroStrategy. MicroStrategy over the last, I think, 6 months bought the next 2 years of Bitcoin supply. It's insane, the numbers. first question is, what would happen to Bitcoin if they discover not all the gold is at Fort Knox?
Oh, Bitcoin's going through the roof.
That's what I think too. Good. Second question.
Yeah.
And in terms of Bitcoin top indicators, you talk a lot about when to identify the top and when to go risk off or take some off the table. Like a two-part question. One, what do you use to identify that top for Bitcoin specifically? And second, do you sell it all or do you hedge it or just take some off the table?
Yeah, we do whatever Dr. Mo tells us to do on Bitcoin. So let me throw one more chart here, and I'll be quick. So Dr. Mo, that was the table that we just highlighted with all the proper trade recommendations in it. You basically, as a client, before you can macro, you're just doing whatever our KISS allocations say until it changes, or you're doing whatever the Dr. Mo proper trade recommendations say for the factors that you care about until they change. They generally don't change. Maybe there's 1 or 2 changes per year at most, but generally speaking, they don't change. So basically, you should only be making like 1 to 2 investment decisions a year. Basically, most people are making probably 30, 40, 50. And 90% of those are generally negative net present value decisions, but that's neither here nor there. So do less if you hear do less as an investor. It goes back to Bitcoin. If you look at the cumulative performance by proper trade recommendation, and this goes back to the inception of the asset class, 100% of the cumulative performance of Bitcoin, 108% actually. So you would have made $1.08 if just following Dr. Mo's proper trade recommendations, as opposed to the dollar you could have made just being naked long Bitcoin. Right. So Dr. Mo trades Bitcoin better than Bitcoin trades itself. And so when the proper trade recommendation changes, and that's a function of 2 things. 1, the market regime changes to a risk off regime, or 2, Bitcoin's own volatility adjusted momentum signal breaks down to bearish. Right. If it breaks down to bearish, that'll be a signal, hey, reduce your allocation to Bitcoin. And then the overarching signal to reduce your allocation to broader risk assets is the going back to what we talked about with the proper trade the market regime. And so if the market regime changes to risk off, then then Bitcoin's allocation will change and our KISS and Dr. Mo signals. And if Bitcoin breaks down to bearish itself, then it'll get doubly worse, right? And so the reason this matters, the reason the institutional investors invest like this is because when you get the signal and respond to the signal on time, that is when you make and save the most money in asset markets. You do not make and save the most money in asset markets by predicting when the signal is going to occur, because that's when you have the maximum amount of tracking error relative to what is actually happening in the market.
Yeah. And my perspective, because I saw there was short positions there, this takes them off the table to leverage. My position is when we're in a bull market, you layer in up to certain prices, and then you start layering out once you go beyond a certain level. And then for the stuff that you keep on the table, you hedge. That's kind of my approach to the world, which it looks very similar to your model, which is great. Okay, let's talk about AI and technology, because that is, as far as I think you are concerned, there's 2 narratives. It's AI and it's crypto, Bitcoin. We have a huge amount of change coming in the world. It's pretty clear. There's a lot of fear mongering out there that AI is going to disrupt everything. It's going to take everybody's jobs. I think, first of all, it will put pressure on upward salaries. You won't have people coming out of college earning $250,000 a year when 2 people earning $40,000 a year using AI proficiently can do a lot more work, perhaps. And that's from people like David Sachs and Shamath Palihapitiya. Their view of AI. It makes less people a lot more effective and efficient, and it can reduce, like if you look at the venture capital industry, they used to do $4 million, $5 million Series A rounds. Now they're doing $50,000 rounds because you can get to proof of concept much faster. Easy way to think about it. Now, when we think about AI, it's radically...
By the way, the most structurally bearish thing I've heard in probably months. You're saying the VCs, the people closest to the development of AI, are now, they've haircut their allocation to their investments in terms of the money that they need their investments to go out and hire people with by 90%.
Yeah. Basically, the problem is there's so many bets. They can no longer have a concentrated bet on, say, an Amazon.com or a Zoom or something like that.
It's always spread out. That's not new. Yeah.
But now you can. So the problem is the persistence of a technology or an open source model can be replicated in a heartbeat. So the company that wins this week could be dead next week and replaced by a better company. That's the problem, and that's the VC industry, which I know quite well, is very very flummoxed by this.
Oh,
And
the world's going to be flummoxed by it in 5 years.
yeah, it's strategy. But taking us back to this and how this impacts a topic which I don't talk about too much, but I'm very worried about as well, is the fourth turning. So AI could trigger a lot of uh, automation of jobs, job losses, social unrest, misinformation, chaos, AI shifts, faster wars, more technology-driven wars, different ways in which wars are fought using drones and AI, a complete cultural breakdown. If everybody's dependent on UBI, people will lose hope. I mean, I could go on, but the point I'm trying to make is typically the fourth turning is a 20 to 25-year cycle. It kicked off in the global financial crisis, you could argue, and I see AI accelerating it, compressing it. And by 2030, the fourth turning cataclysmic stage could be here. And I hope you please tell me I'm completely wrong, but that's my paranoid mind talking out loud.
No, that's not. I mean, you're not paranoid. You're just someone who's educated and studied this stuff, right? You know, I think I've Neil Howe. Neil Howe's one of my mentors on Global Wall Street. Yeah, I've known the guy for 15 years now. I find myself to be very as versed in this stuff as anyone not named Neil Howe. Certainly, in terms of the amount of quantitative analysis we've added to this discussion topic. You know, it's not just the qualitative analysis. You know, we've done a lot of deep dive empirical, you know, analysis that sort of helps investors understand, okay, where are we in this fourth turning cycle? How's it going to impact the economy, asset markets, policy, et cetera, over the medium to long term? So I think we, you know, I think I would say Darius Dale is one of the people, you know, 5-10 smartest experts in the world on this topic, and Darius Dale shares all the same conclusions that you just outlined. So that's.
I was hoping you'd give me some comfort here, buddy.
Yeah.
You're completely wrong.
I don't know.
It's going to be fine.
I don't know if it's comforting, right? You're talking about a really draconian outcome. Like, well, let's take a step back, right? If AI doesn't replace humans, then what the hell are we doing, right? We've capitalized all these companies well beyond any normal level of valuation. That we're talking about a Great Depression style collapse in equity markets. If AI is not productive and useful enough to replace people doing white collar stuff, right? That's the whole point. You're making a system that's smarter than people. Why can't it do things that people do? If it doesn't do things that people do, we're going to have a Great Depression style collapse in the stock market. And if it does what we expect it to do, which is, I have a bunch of friends that run AI companies. I'm sure you're plugged into that ecosystem as well. If it does what those guys and your guys, your channel checks think it can do, which I also think it can do and will do in the next 5 to 7 years, you will see a lot of people on the dole. You will see calls for universal basic income. You will see the Medicaid budget in the United States of America explode to, you know, 2, 3, 4, 5, 10 trillion dollars. You know what I mean? Like, these are the kinds of things that happen in fourth turnings, right? I'm not saying AI is the reason that we hit the climax phase of the fourth turning, but it is very likely to be a catalyst in terms of the great institutional and societal change that could catalyze. So I think we got to really keep our eyes on the prize here. Not going to happen overnight, but if investors hear this kind of stuff from really, really smart, highly educated people, and they think we're crazy, then it's probably them that's crazy.
So back to brass tacks. What are the two things you would advise people? What I tell them is, it used to be an old Swiss German saying, you grip the worry, heb die Sorge. But here, people need to embrace AI and learn how to leverage it to survive. And then second of all, in terms of positioning, we can no longer depend on the government to look out for us or a university to give us a great education to set us up for life. That world is gone. It's different right now. We need to become much better capital allocators to be in the top percentile of the future. They're two very profound statements, which we could talk about for 5 hours or over a beer one day, I hope. But final thoughts on those two items.
Yeah, I generally agree with what you're saying. I would add another thing, a couple other things. One, blue collar. If you're listening to this and you still have a choice, blue collar. Like, my brother's an elevator mechanic. He might be making more money than me in 10 years. You know what I mean? Like, I'm not even joking. I
know. A plumber in San Francisco makes $600 an hour.
Yeah, totally. That's what I mean.
New York lawyers 300.
Yeah.
So
think about that stuff.
It's already.
I know lawyers make way more than $300 an hour. Well, so what was I going to say? So on that, because if you're young enough to consider this, you know, a high technically skilled blue collar industry, I would highly recommend you consider that, as opposed to being the 100,000th person in the global financial services industry, that's, many of us are not going to have jobs in 10 years. We won't need to have jobs in 10 years. Then, and so the second thing was climb the corporate ladder as quickly as possible. Be as close to making the decisions about the future of headcount at the company you work for. That'll give you the maximum amount of time to stack capital and grow your investable assets in order to take advantage of any sort of market trends to build your wealth. Right? If you're able to be fired, the probability that you will get fired will rise substantially in the next 5 to 7 years. Period.
Well, and what about people? You mentioned stack, but through the corporate ladder to earn paycheck.
Climb that corporate ladder as fast as possible, or start your own company and be successful with that.
But how do you personally allocate to technology and AI today? Do you own NVIDIA, Tesla, names like that? Or what do you tell your clients to do?
Indirectly. So going back to our 60-30-10 trend following strategy, that's our flagship investment strategy. We have thousands of retail investors all around the world allocating to it. It's just 60-30-10 stocks, gold, Bitcoin. So SPLG was the S&P 500 ETF. Obviously has a significant weight to a lot of those AI exposed names. So that is our way to participate in this kind of exponential age theme. And you and I obviously know Rob Paul really well. Bitcoin obviously is an allocation to that. And then I think gold. I mean, I don't see how gold doesn't rip in a scenario where you're talking about potential mass unemployment in the U.S. Significant expansion of U.S. fiscal expenditures and budget deficits. And if we're wrong about all this draconian AI stuff, then it means that we actually got our fiscal house in order. AI didn't create mass unemployment. And oh, by the way, stocks are up through the moon. Probably S&P, 16,000 as opposed to 6,000. So I don't see how there's a way to lose, obviously, but I still think that the probability of winning with an allocation like that over the next 10 years is much higher than the probability of losing.
By the way, since we've been talking,
Bitcoin. You have a hard stop. I'm sorry. It's another meeting. I'm sorry.
Bitcoin went up $1,200 since you jumped on. So bring the good juju. Keep it going. Thank you so much, Darius. I know you got to run. Really appreciate all your insights. And we have to do this again because we've really scratched the surface of where we need to go in the future.
You and I need to set up somewhere in a bar with some beers and just go deep.
Yeah, for sure. Links below for Darius. Follow him on Twitter. Check out his website and all his reports. Thank you, buddy. Have a great week.
Appreciate you, brother. Thanks again for having me.
My pleasure.
All right, man. I'll see you next time, brother. Thanks, James.
Bye.